Every time you show up for work, your employer is making a promise to you. Your salary, your vacation, your health insurance, and maybe the biggest one of all, your pension. These are all promises for future payment for the work you're doing right now. But a promise, well, it's only as good as the ability to actually pay up. So that's the big question, isn't it? How can we be sure that a company has really thought about the massive financial weight of all these promises? How do we know they can actually afford what they've offered, sometimes for decades into the future? Well, turns out there's a rule book for that. Okay, let's get into it. That rule book is called International Accounting Standard 19, or just IAS 19 for short. It's the global standard that basically forces companies to look their promises right in the eye and put a real number on them in their financial statements. So here's what we're going to cover. First, we'll talk about the core idea. A promise is a debt. Then, we'll unpack the four main types of benefits, and we'll really zoom in on what I'm calling the Great Pension Divide. After that, we'll touch on benefits for the end of employment, and finally, wrap up with why all of these rules really matter. All right, let's start with Section 1. A promise is a debt. Honestly, if you only remember one thing, this should be it. It's the whole foundation. So first, let's just get our terms straight. The standard defines employee benefits super broadly. We're not just talking about your paycheck. No, it's everything a company gives you for your work, from healthcare to housing allowances to that pension way down the line. And right here, this is the core logic of IAS 19. It says that if an employee works for you this year, they've earned a benefit that you have to pay later. That creates a debt, a liability, that has to go on the books today, not years from now when you finally pay it. Simply put, service today equals debt today. Okay, let's move on to Section 2. Now that we have the main idea, let's see how it plays out. Because IAS 19 doesn't just lump all these promises together, it actually breaks them down into 4 different categories based on when they get paid. So IAS 19 sorts all these benefits into 4 main buckets. You've got your short-term benefits, post-employment benefits, other long-term benefits, and finally, termination benefits. And as you're about to see, that second one, post-employment, that's where things get really, really interesting. Let's start with the easy one, short-term benefits. These are all the things the company expects to pay out within 12 months of you doing the work. So this is your regular salary, paid vacation, any annual bonuses. It's pretty straightforward to calculate and account for. But then we have post-employment benefits. And this is the big one. These are the benefits paid out after you stop working, which could be decades from now. We're talking pensions, retirement plans, and post-retirement healthcare. This is where it gets complicated, and frankly, where the biggest financial risks are hiding. And that brings us to the main event, here in Section 3, the Great Pension Divide. Because to really get a handle on the risk, we have to split these post-employment plans into 2 completely different types. First up, we've got the defined contribution plan. Okay, picture your retirement savings as a big jar. With this plan, your employer promises to put a fixed amount, a defined contribution, into your jar every year. And after they do that, well, what happens to the money is up to the stock market. The investment risk is entirely on you, the employee. Now, on the other side of the divide, you have the defined benefit plan. Here, the company's promise isn't about what they put in the jar. It's about the final outcome. They guarantee your retirement jar will have a specific amount, a defined benefit when you retire. If the investments in that jar do poorly, guess what? It's the company's problem. They have to top it up because they carry all the risk. Looking at them side by side like this makes the difference just crystal clear. With a contribution plan, the company's job is done the moment they pay in. But with a benefit plan, their job is to deliver a final number no matter what it costs. It all boils down to one simple, crucial question. Who is carrying the risk? So, because the company is on the hook for that final number in a defined benefit plan, they suddenly have to become fortune tellers. They need to hire experts, actuaries, to make these incredibly complex predictions. How long will you live? How long will you stay with the company? What will your salary be in 30 years? It's a massive forecasting headache. And all that complexity creates this pretty intense accounting to-do list. Every single year, companies have to figure out the gap between what they've promised and what they've actually saved. Then they have to report those changes in different places. The day-to-day costs hit the main income statement, but the bigger swings from their long-term predictions get reported somewhere else. It's this constant adjustment to keep the books in line with a very uncertain future.
All right, let's head into our fourth section and quickly round out the picture with those last two categories, the benefits you earn over the long term and the ones paid out right at the end.
Other long-term benefits are kind of the catch-all for promises that don't fit in the other buckets. Think about things like a sabbatical or maybe a special jubilee bonus you get after working somewhere for 25 years. They're not short-term, but they're not paid after you retire either. And finally, we have termination benefits. Now, these are unique because the company's obligation isn't created by your years of service, but by the actual act of ending your employment. This is your severance package. The accounting for this kicks in the moment the company commits to the layoff, not over time. So, after all that detail, we finally arrive at the most important question of all. Why does any of this matter? Well, it really all comes down to two simple words: transparency and trust. Before standards like IAS 19 existed, these huge long-term promises could just be sort of hidden off the books. But this standard forces them right out into the open. It gives investors, employees, anyone really, a clear, consistent, and comparable picture of what a company's true obligations are. And that brings us right back to where we started. The entire point of this whole thing, as the standard says itself, is to make sure that when an employee provides service, the company recognizes the liability. It turns an abstract promise into a very concrete financial number. Ultimately, IAS 19 makes sure that every promise has a price tag, and that price tag is put on the books for the whole world to see, which kind of leaves you with a question to think about. When you look at your own job, what's the true long-term cost of the promises your employer has made to you?